This is Matthew Cratter from Trader University, and today I want to talk about the dangers of penny stocks. A lot of you have been writing into me with your problems in various stocks that are penny stocks, so I just wanted to put out a reminder for everyone about how penny stocks actually work. If you're interested in learning how to make money in both bull and bear markets, or you just want to see what I'm trading or investing in, be sure to hit that subscribe button. So when you buy a penny stock, or if you trade penny stocks, you are basically like a fisherman who is fishing in a sewer or a drainage ditch. These kind of companies and their associated stocks, these are the worst companies. They're almost always terrible businesses run by shady operators, and the stocks are highly manipulated. They're fairly small, they have fairly small market caps usually, and so they're very easy to run pump and dump schemes. If you just Google buy penny stocks, you'll see a lot of these penny stock newsletters where Fierce Investor, Penny Stock Millions. I don't know anything about these companies. I assume they're complete garbage. But what they will do is they will often try to get all their subscribers to run into a certain penny stock. And because these stocks are so small, it can drive the stock up. But then as people try to get out, the stock plummets. So there are a lot of unscrupulous operators in the penny stock arena. What I found is that stocks, even stocks under $20 a share, do not trend as well as stocks over $20. So if you're looking for really good momentum stocks and high quality companies, you always want to look at stocks that are priced above $20. Now, even stocks under $10, they tend to be even worse. They tend to be much more mean reverting. So for example, you might have a stock that starts at $3, it's trading around $3, it spikes up to $6, and then it falls back down to $3. That's what I mean by mean reverting. It reverts back down to its average trading price. Now, some people think this might be a good trading strategy. There are various people who promote this online, but the problem is the risk reward on shorting penny stocks is just not very good, because even if you're able to borrow the shares, can be difficult, in order to short a stock, you have to borrow the shares from your broker. Even if you can do that, the risk reward is completely off, because if you short a stock at $6 a share, hoping for it to mean revert back down to $3, what often can happen with these penny stocks is they will spike up to $10 or $15 before falling down to $3. So here's a stock that a bunch of people got wrecked in, GNUS, Genius Brands International, which I'll be talking a little bit about later in this video. But you can see here, if you shorted it on this spike, which I don't know exactly what caused this spike in 2020. Maybe it was pump and dump, maybe it was some company release. But if you shorted it at 6, expecting it to mean revert back down to 3, you were basically correct. But unfortunately, it first went almost to 12. And if you short something at 6 and it goes up $6, you basically lose 100% of your capital, even if you're not using any leverage. And so you can be right and still end up losing 100% of your capital. So it's not good to short penny stocks. I don't like the risk reward. You can't sleep at night, and it's not good to go long them. We'll talk a little bit more about that in a second from now. But I just wanted to point out some basic math, that stocks that trade under $10 a share, they're very volatile, for the simple reason that when you have the movement of a stock on a smaller base, you get a much higher percentage move. So a $1 move on a $5 stock is a 20% move, which is just enormous. That can really make you a lot of money or lose you a lot of money very quickly, whereas that same $1 move on a $100 stock is just a 1% move. This would be a more normal daily move for a stock. So it sounds like this could be a lot of opportunity. I mean, who doesn't want to make 20% on their money in a day or two? But the problem is that most of these are trash companies, and they are pump and dump schemes. There's another thing that makes penny stocks very difficult to trade, and I learned this the difficult way. I learned this the hard way back in the 90s. This liquidity can disappear at any time. So these numbers are just approximate. This may have been before decimalization, so maybe these were quarters. This was probably something like 2 3/4. But either way, the principle still holds. So I once bought a stock for $3. And again, this was in the late 90s. It was a penny stock. The bid was at, call it 2.75 or 2 3/4 back before stocks were quoted in decimals. The offer was at $3. I just bought it right from the offer because it was very fast. All of a sudden, I look at the stock, and a couple hours later, the bid has fallen down to 1.5 points, 1.50, and it never came back again. So this can be a situation where you have very wide bid-ask spreads, and this is what I mean by liquidity can disappear at any time. So this stock, if you were looking at the time and sales for the stock, you might see it trading at 150, and then next it would trade at $3, and then it would trade at 150 again. And it would look like maybe you could double your money. You buy it at 150 and sell it at 3 and just do this again and again. But what in fact was happening is when people sold to the bid, the stock price, the trade would be at 150. When they bought from the offer, like I did, the stock price would be at $3. So this is a 50% move in the market cap of the company, and it's basically just what's called bid-ask spread bounce. And so this is another reason you want to avoid penny stocks, because you can really get trapped in them. There's no guarantee that that bid will be there when you need it to be there. So let's go back to GNUS just to use this as an example company. If we scroll out, we can see that this used to be a somewhat legitimate company, but even then it IPO'd in 2014. It was trading below $20 a share. It came out around $13, $14, and it's gone generally lower with a couple pump and dump spikes in the meantime. Now, if you're gonna buy a penny stock, you need to know a lot about the industry. You need to be able to read financial statements. If you're going to buy one of these as an investment, for example, you'll find lots of scammy solar companies, biotech companies, even electric vehicle companies that trade for a couple dollars a share. But you need to be able to go in and take a look at the financial statements. I'll give you an example here for GNUS. Anyone who bought this, all they needed to do was take a look at the income statement. Now, obviously, you can buy penny stocks. You can trade them technically. There's nothing wrong with that. I trade momentum stocks all the time that are higher priced, that I don't know a whole lot about the company. I haven't read the whole 10K, for example. But the problem is when you're dealing with penny stocks, you have the illiquidity that we've talked about. You have the fact that bid can disappear. You have the huge volatility, etc. So I don't think they're a very good place to trade. They might be a good place to invest if you actually understand the underlying company. Now, in my experience, most of these are junk companies. Let's look at GNUS, Genius Brands International. If we look at the last 12 months of this is the income statement. If we look at the last 12 months of financial data, total revenue for the last 12 months is approximately 5 million. You can see all these numbers are quoted in thousands, so you need to add 3 zeros to this. So they made 5 million in revenue, very similar to 6 million the year before. That looks fine. But then we scroll down and we look at net income available to common shareholders, and they managed somehow to lose $15 million and on a revenue base of earning $5 million. The year before, they lost almost $15 million. The year before, $9 million. The year before, $5 million. So this is a company, it looks like they put out kids' cartoons, or they do some sort of licensing agreement with kids' cartoons, but they haven't made money in many years. You can see even in the year before, it looks like they lost $6 million. So it's okay to be a money-losing SaaS company, a Silicon Valley company, but if you're doing kids' cartoons and you're losing millions of dollars every year, you have to ask yourself, what kind of business is this? And how are they even able to do it? Well, the way they're able to do it is they keep issuing new shares of stock. So if we look at net common stock issuance, here I'm on the cash flow statement. They've been issuing a few $1 million worth of stock every year to pay for, to help pay for their losses, to bring money into the company. They've also borrowed some money as well, but you can see that each year they issue a few $1 million worth of stock to tide themselves over, and also to pay their highly compensated executives who are in charge of, to remind you, a money-losing company. So here's Andy Hayward, typical sort of penny stock guy. It sounds like he had some involvement with Scooby-Doo and the Flintstones, etc. But what he's doing with this company, if we drill down, obviously the company is losing money every year. if we take a look at the SEC filings, we can see that it's just full of what are called related party transactions, where you have people giving deals to each other within the company, and even Mr. Hayward, who earns a salary and earns tons of shares of stock, gets lots of stock options, which he then exercises, as we'll see. He is paying himself left and right. So we can see here that under his employment agreement, this is basically his company. He has total control of it. He's the CEO. He's the chairman of the board. He's entitled as an executive producer to make $12,400 per half-hour episode as an executive producer. This is in addition to his job as a CEO and his regular salary and stock options, as we said. So if you see a low price stock, you can take a look at the company. You can read about the people. They're usually pretty scummy people that are paying themselves really well. And you see this again and again and again. I can't find where it is right here, but he also had here it is. On July 2016, the company entered into a consulting agreement with Foothill Entertainment, an entity whose chairman is Gregory Payne, our corporate secretary. So this is basically one company moving its slush fund to another company, and so he is able to make $12,500 per month in addition to a salary as corporate secretary, and this is money that's coming from, this is basically a consulting agreement between Genius Brands International and their corporate secretary. So lots of self-dealing. Everyone who's on the board or who's an executive there has all these deals on the side and is getting paid lots of money. In fact, I would say that the main genius of this company is not in their kids' cartoons, but in the fact that they've been able to double dip so many different times and make themselves so much money. But unfortunately, if you buy this stock and help to prop up the stock price, you are contributing, you are helping Andy Hayward live his lavish lifestyle in exchange for running a company that is constantly losing money. I have no problem with people making millions or billions of dollars if they're actually providing something useful to society. But this is an example of a guy who is just, at least it appears to me, I don't know him personally, obviously. This is just my opinion based on reading what's available online. But he looks like a total scumbag to me. We can see here that he recently sold on June 19th, 2020, dumped $1.3 million worth of stock. And then a couple days later, he converted some options. He exercised his options to get 12 million more shares of stock that he basically granted himself as chairman of the board and CEO. So here's a guy who's not only making $12,500 per hour consulting for his own company in which he's a CEO, but also he's dumping stock on people who are naive enough to buy a penny stock like this. Now, there's a real appeal to penny stocks. If something's trading at $1 and you have a $1,000 account, it's really nice to be able to buy 1,000 shares of stock. Sometimes you'll see penny stocks that are trading for fractions of a penny, 0.00002. And in these stocks, you feel very powerful because you can literally buy, with just a few $1,000s, you can literally buy millions of shares of stock. But there's usually a reason for that. And that's because the company is junk, and you're taking a really large risk for doing that. So to summarize, if you're a beginner, don't even look at stocks under $20 a share. Never buy a stock under $10 a share unless you can read financial statements, read the income statement, cash flow statement, and balance sheet, or if you really understand the industry and the company's prospects. So I'm obviously, if you're an MD, PhD who understands immunology or autoimmune diseases or something like this, and you find a penny stock, a biotech penny stock, then feel free to invest in it if you understand the technology, if you trust the people who are running it, etc. But most people who buy penny stocks, they buy them just because a friend at work told them about it, or a guy at the gym, or they get one of these crappy penny stock newsletters, and they end up getting wrecked. I get emails every single day from people who've been wrecked in penny stocks. you're almost always better off buying one share of a $100 stock than 100 shares of a $1 stock. If the stock goes up 5 or 10%, you'll still make the same percentage on your money. It doesn't matter how many shares of stock you own. And in addition, many brokerages, this used to be a problem for people with small accounts, but now there are many brokerages, including Robinhood, that now offer fractional shares. So you can buy less than a single share of stock. You can buy a high-price stock like Tesla used to be before it split, or like Apple used to be before it split. And so this really opens up a whole universe of stocks to investors who weren't able to access them before. Now, these penny stock principles apply as well in the cryptocurrency space. A lot of people get confused by this, and they look at Bitcoin and they say, oh my gosh, one Bitcoin is $16,000. I could never afford that. They don't realize that each Bitcoin is divisible into 100 million units called Satoshis. And so basically anyone can buy a Bitcoin, a fraction of a Bitcoin. You can buy $5 worth of Bitcoin or $10 worth of Bitcoin, or you can buy $1 million worth of Bitcoin. It's a very liquid market, unlike these penny stocks. People get confused. They see that Bitcoin's at 16,000, and then they go down here and see XRP is at only 27 cents. And they're like, wow, there's so much opportunity here, because what if XRP becomes like Bitcoin? My 27 cents will turn into $16,000. Unfortunately, what they don't realize is that the max supply of XRP is 100 billion units. There are 100 billion XRP out there. There's slowly, some of them are being burned. You can see that the supply is slowly shrinking. But if you compare this 100 billion total XRP supply to Bitcoin, which just has 21 million Bitcoin available, you begin to realize that Bitcoin is scarce. XRP is not scarce. XRP has, it's run by scammy operators just like GN US. These are very similar people who make their way into crypto, a lot of cryptocurrencies in addition to penny stocks. So in my experience, you actually are better if you're just going to close your eyes and throw a dart at a dartboard. You will actually do better buying higher priced stocks and higher priced cryptocurrencies. I only like Bitcoin at this point. Ethereum's very interesting, but don't get fooled by these very low priced cryptocurrencies. The inventors of XRP were very clever, issuing so many XRP and then making the price very affordable for people, and not really preying on investors' naivete in this area. And so if you look at the performance of Bitcoin over the last few years, or you look at the performance of Apple or Tesla or Amazon, these are high-priced stocks, high-priced cryptocurrencies, and they've actually done much better than all the low-priced ones. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video on YouTube. And let me know your questions and comments in the comment section below. If you've had a bad experience with a penny stock, feel free to share them. Literally thousands of you have had bad experiences with penny stocks. So if you've lost money on one, or you're still holding on to one hoping it's going to come back, you're not alone. You're probably better off just getting out of it, though. These things usually never come back once they crash. Thanks a lot for watching, and I'll see you in the next video.